Hello everyone, I hope you're well. My name is Michael, and in this video, we're going to do a walkthrough of creating a narrative and fair value estimate on Simply Wall Street. If you're not familiar with narratives, we have a video that explains the purpose of narratives, where you can find them, and how they help you gain deeper insights. There is a link in the description to that video if you're interested in watching it. But a quick summary is that narratives are the foundation of the investing process and our Simply Wall Street investor community. Narratives allow you to capture your thoughts, monitor how your expectations are unfolding, and share your perspectives with other investors. So in this video, we're going to show you how to get the most out of narratives while going through an example of creating one to decide if a business is good and if now is the right time to buy. Until recently, you've only been able to set a fair value estimate on Simply Wall Street and take some notes. Now with narratives though, you can capture your perspective on a stock, set a fair value estimate using our Valuator tool, and monitor your perspective to make sure it's unfolding as you expected or adjust when necessary. Narratives are key because they allow you to maintain your portfolio of perspectives over time and ultimately make informed buy, sell, and hold decisions throughout your entire investing journey. Here we can see I've got Netflix on my watch list. It's a company that I've been following and researching for a while, and I've just been using the consensus analyst price target for my fair value estimate. However, I've been getting to know the business for a while now, jotting my notes down here, and I now feel confident enough to create my own narrative and share it with the community to get feedback on my perspective. This is because I want to sense check and stress test my narrative just to make sure that I'm not missing anything, because I'm sure there are aspects that I might miss that the community could help me with. So here, I'm going to click Build Narrative to create my own. Now I'm going to use my previous notes that I've done during my research to help me build my narrative. I know some people have a good idea of how they want to present their thinking, but I'm a little bit lost as to how I should start. So, to get some guidance on how I could structure my thoughts, I'm going to click Get Ideas to see what sort of templates Simply Wall Street suggests. Here, they've given me a framework of catalysts, assumptions, risks, and valuation. Catalysts are what underlying business or industry changes I believe will drive the future of this business. Assumptions are how I'm going to quantify those catalysts. Risks are where I'd outline what could go wrong with my narrative, and valuation is just where I explain what methodology I use to get my fair value estimate if there is anything that the valuator on the right here isn't describing already. This seems like a useful framework, so I'm going to use that for now. So, pulling up my notes, I'm going to try and answer these questions to build my narrative. From my notes, here's what I've got. For a catalyst, I've got a note here that I jotted down. It says, I'm bullish on ad plans growing subscribers and revenue per subscriber. And I've got a link to some research and reasoning. That's definitely a business driver, so I'll add that in as a catalyst. On another note on the side here, I've got some thoughts as to how I think subscriber growth and average revenue per member could develop over time. This looks like it would suit as an assumption for this catalyst. When I looked into it, I felt that the business could potentially reach 350 million subscribers by around 2029, and due to new revenue from advertisers that will grow on top of the price paid by ad-paying users, the average revenue per member should increase as well. It was $141 in 2022, and I believe it could reach $178 in 2029 due to price increases, but also new revenue from advertisers. So, as for my assumption and how I'm quantifying that catalyst, I'm going to put this note here in on the narrative. Nice. Now, while I think this is likely to happen, I could obviously be wrong. We live in an uncertain world after all, so it's important to think in probabilities. I know I looked into the tough competition in the streaming space, and if things heat up there, or people chip away at Netflix's competitive advantages, that could derail my narrative. Nothing is a sure bet, so what I'm going to do here is put the risk in to show that I've considered what could go wrong and why I don't think it's a high likelihood, but something that I'll continue to monitor nonetheless. Cool, okay, that's done. Now, the next part is bringing it all together in a valuation estimate, the fun part where I get to play with charts. Since I've now laid out my catalyst, assumption, and risk, I'm going to try put a final figure on it because I have most of the basic inputs I need to reach a fair value estimate using this Valuator tool. It's worth pointing out that I can't make informed estimates about the future and do a valuation without having a solid understanding of the underlying business and what's potentially going to occur. So that's why I do catalysts, assumptions, and risks first before trying to reach a valuation. If I try and do it the other way around, like do a valuation before the narrative, I'm just speculating and not supporting my valuation forecast with reasonable evidence. For example, How could I possibly know to pick a certain revenue growth rate if I don't know how revenue was going to grow? As for the method of valuation, I'm simply going to use the same future PE multiple approach that is on the right hand side here in the Valuator tool. Essentially, a future PE multiple approach is just trying to imagine where the business metrics could be in the future based on my understanding, and then what I believe the market will pay for it by then. Firstly, this is a personal preference, but I'm going to go with a 5-year time frame. I feel that's a happy medium between thinking far out into the future, but not too far where my estimate could be way off and it's hard to be confident or accurate 10 years from now. I could go with 3 or 10 years if I felt confident with those time periods, but for me, 5 years suits just fine. With that done, I'll now start with revenue growth. I said in my narrative that I believe subscriber and average revenue per member growth will result in $62.4 billion in revenue by 2029. Now, to figure out revenue growth, I can either move the slider here until I get the number I need in the chart, or I can type the number in above the slider. In this case, to get to $62.4 billion in revenue by that year, it looks like it'll need about 11.45% revenue growth per year. For some sense checking, I can see that Netflix is currently growing revenues at around 10% per year, and the entertainment industry is only growing revenues at 0.3% per year. I feel confident that Netflix can reach this 11.5% figure, but I would rely on those bits of context below if I didn't understand the business as well as I do. As for margins, I've also done some research there, and I believe that they can maintain their current margins as they continue to scale and get a handle on their content spend. So I believe margins will be maintained at around 20%. And if that's the case, that means profits in 2029 will reach $12.5 billion. Those margins are slightly higher than where they currently are, but well above the entertainment industry, which is great and a sign of their competitive advantages. Okay, next, as for the future PE ratio on those earnings in 2029, that's a bit more of an art. I can see it's currently trading at 39 times earnings. Its forward PE is around 30 times earnings, and the entertainment industry is currently trading at around 23 times earnings. From my perspective and my understanding of the business, I reckon its PE ratio will be lower by then than it is today, as its future growth prospects by that time will probably be a bit lower than they are today. However, it's such a high quality name that I think the market will continue to pay a premium for this business compared to the entertainment industry. So I'm going to assume a PE ratio of 30 times earnings on those 2029 earnings. Lastly, if I'd like to, I can change the discount rate. Now, I can either stick with Simply Wall Street's current discount rate on the company, or I can make my own. Simply Wall Street is currently using 7.4%, which I'm more than welcome to stay with, but I'm going to increase this to 10% in order to be a bit more conservative. The discount rate is to account for not only the time value of money, but the uncertainty as to whether these future profits will actually occur. So I need to be compensated for the risk that I'm taking. Also, the discount rate essentially represents my minimum hurdle rate for my investments, as in what rate of return would I like to receive from my investments. Put another way, if all my future estimates end up being correct, and I paid my fair value estimate for the stock, I could expect to receive whatever my discount rate is per year as a return. So, with safe government bonds generating yields of around 5% at the time of this recording, I'd like to invest in stocks that have the potential to generate more than, say, 10%. This is to account for the fact that I can place a quote-unquote sure bet with government bonds and get around 5% yield, or I can take on more risk and uncertainty to potentially get 10% or more. So that's why I'll be a bit more conservative and increase the discount rate, but you can of course do as you please. The lower the discount rate, the higher the price you'd be willing to pay, and the higher the discount rate, the lower the price you'd be willing to pay. Alrighty, so with all of those assumptions and calculations done, that gives me a fair value estimate of 652. I'm happy with all those inputs and reasoning, so I'm basically ready to go. The very last thing I need to do is summarize my narrative with a title so that people know what to expect if they read my narrative. I'm going to go with a title that explains what I think my catalyst will do to the underlying business. We've found that the best format for titles is X catalyst will Y outcome. So that's why I'm going to give my narrative the title of Netflix ad plans will increase average revenue per member and total revenue. I won't mention valuation in the title because that's going to be right beside my title anyway, so no need to say whether I think it's under, over, or fairly valued because my valuation does that for me. Now that I'm happy with all this, I think I'm ready to share it with the community. I'll click save, and that will now be available to Simply Wall Street users. And that's done. My narrative has been created. At today's prices, it looks like I think it's fairly valued. So I will monitor any new information that comes out that is relevant to my catalyst assumptions or risks to see how they're all tracking, and I'll adjust my narrative or fair value if I need to. I'll continue to watch the stock and set an alert here in my notes to notify me if the price dips below $520, because that is about 20% below my fair value estimate of $650. That price would give me a little margin of safety in case any of my calculations or estimates are slightly off. I'll turn on my personalized update notifications on my account so that I receive relevant updates to my email to keep my finger on the pulse of Netflix and my narrative around it. To wrap up this video, we've got a lot in the pipeline coming soon for future improvements and updates to narratives that we're really excited to release. As always, we'd love to hear from you, so if you do have any feedback, please feel free to leave it at the top of any narrative here where it says give feedback, or in the comments section on this video. That's all for this video. Thank you so much for watching. And until next time, invest well.